Good day to all. My name is Chloe, a senior research analyst from iFAST. The healthcare sector has always been a reliable choice for investors looking for a defensive play. It has consistently outperformed broader markets during periods of market downturns, thanks to the relatively inelastic demand for healthcare products and services. This means that even when the economy takes a hit, people still need healthcare, and the earnings of companies in this sector tend to be better protected. In addition to its defensive nature, the healthcare sector has recently shown strength during its earnings season. Major players in the industry have exceeded their earnings and sales estimates, which is a positive sign for investors. This demonstrates the sector's resiliency and reinforces its reputation as a safe haven. However, it's important to note that while the sector as a whole is known for its defensive attributes, it offers some form of growth opportunities. One of the key drivers of growth in the healthcare sector is its ability to deliver significant innovation to patients. With advancements in technology and research, healthcare companies have the potential to develop groundbreaking treatments and therapies that can transform the industry and improve patient outcomes. Given the mentioned factors, we maintain our 2.5 stars neutral rating for the healthcare sector. This rating reflects our appreciation for the sector's overall quality and defensive nature. Investors can find comfort in knowing that healthcare companies have a strong foundation and are likely better able to weather market storms than others. However, it's important to acknowledge that there's limited upside potential with projected gains of around 21% by 2025. And while the healthcare sector offers stability and resilience, it's essential for investors to consider their individual investment goals and risk appetite. Some investors may prefer sectors with higher growth prospects, while others might prioritize stability and consistent returns. It's crucial to strike a balance in one's portfolio and diversify across different sectors to manage risk effectively. To get the full analysis, scan the QR code or click on the link in the description below. Next up, 𝗪𝘆𝘀 will share the monthly summary of market movements over the past month. Over to you, 𝗪𝘀𝘀.
Hi, my name is 𝗪𝘆𝘀, iFAST research analyst. The global economy has been rattled by the banking crisis and the looming possibility of a US government default. As a result, consumer confidence has been shaken, and recessionary fears are on the rise worldwide. However, despite these concerns, May brought about some positive news for equity markets, which saw better growth compared to the previous month. The FSM indices showed mixed results in the labour market and inflation rates globally. The overall performance of FSMI All Equity outperformed All Bond, with a return of 2.59% compared to negative 0.6% in SGX terms. The best performer was the technology sector, which delivered an impressive return of 9.04%. This rally was fueled by the excitement surrounding artificial intelligence and the strong earnings performance of companies like NVIDIA, Microsoft, Meta, and Alphabet. Another standout performer was Japanese equities, which returned 5.1%. Japanese equities have been attracting investors due to strong corporate fundamentals, attractive valuations compared to global peers, and the reopening of borders, which bodes well for the Japanese economy. On the other hand, China equities experienced a decline as geopolitical tensions, concerns over China's economic recovery, and recent regulatory crackdowns weighed on the market. Commodity and energy funds also suckered negative returns, with gold-related funds being hit harder than energy-related funds. However, commodities are seen as resilient performers in the face of rising inflation, and commodity-linked equities are considered useful for hedging portfolios in the current economic climate. While the global market faces uncertainties and talks of an impending recession, ASEAN emerges as a dark horse. ASEAN's growth resilience is attributed to a positive commodities outlook, improving tourism, and relatively milder inflation. The region's export revenues, supported by its status as a major commodities exporter, are expected to hold up well. Additionally, recovery of tourism and central banks' forecasts of inflation nearing long-term targets further attribute to ASEAN's growth prospects. Despite this positive outlook, earnings estimates for ASEAN equities remain pessimistic, which seems unjustified considering the subsiding COVID-related headwinds. Valuations of ASEAN equities are currently attractive, trading at a discount to their long-term average multiples compared to their developed market peers. The principal ASEAN Dynamic Fund is recommended for investors seeking exposure to ASEAN equities, with a focus on cyclical sectors like financials and energy. While global markets face challenges, there are opportunities for attractive investment options. Investors should carefully consider their investment goals and risk appetite while exploring these opportunities in the current economic climate. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Jason will share with us about global logistic partners. Over to you, Jason.
Hello everyone, this is Jason from Global Fixed Income team. So I would like to share a bond idea which is GLP. GLP is a leading alternative asset manager an investor in Asia with the asset under management of over $120 billion. There are three main business segments, namely property development, property investment, and fund management. It has a resilient business model with multiple advantages. For example, the asset related to the development segment can be easily exited by selling to the related parties. For example, GLP managed funds, JVs, and associates, which could recycle the capital. The asset can be even securitized once the cash flows are stable. The fund management scale could be enlarged with the better selling price of the asset. Besides, GLP have two types of sustainable revenues, that is the rental revenues and the management fee, which has a higher visibility and stronger cash flows. From the background perspective, GLP has a diamond level shareholder base with the private equity fund, real estate, and banking backgrounds. Actually, the debt level was so high. The net debt to investment and the net gearing ratio were 39% and 53% respectively. The cost of borrowing was low at 4.5%. GLP also has properties and equity investment up to $32.2 billion. These assets have actual cash flows and investment returns, so their liquidity will be much higher than the properties under development. The current GLP managed funds have a dry powder up to $14 billion. These dry powder provide strong liquidity, allowing GLP to dispose their self-owned properties to the managed funds. Looking forward, we expect GLP should continue to liquidate some assets to free up the liquidity for the debt repayment. The 2025 bond outstanding is around $1.3 billion, which is insignificant compared to the asset value of $32.2 billion. GLP clearly has a strong solvency to repay the debt. So to get the full analysis, you can scan our QR code or click the link in the description section. That's summarized for the sharing of this week. Catch up again next week for more investment ideas and updates. Thank you.